Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Stocks made a remarkable recovery following the COVID-19 sell-off in the first quarter, but what's reflected in the stock market is very different than the everyday economy. Doug Forman, Chief Investment Officer of Kayne Rudnick, joins me to discuss. Doug, welcome to Trade Talks.
Thank you, Jill. Great to be here today.
So, Doug, the million-dollar question: how long do you think it will take to repair the economic damage, and have we seen the bottom?
Well, I do think we've seen the bottom. I've told clients for decades that, once everybody recognizes that we're actually in a recession, it's actually over in financial markets. So once it's sort of widely known and anticipated, and, we were really in this condition in the March, April time period because, you didn't need to be an economist or a money manager or a Wall Street strategist to figure out that with 3.5 billion people sitting at home, that we were going to be in a recession. And so, and policymakers, of course, reacted very quickly to that. The Fed and fiscal policy really kicked into gear. Normally, in a normal recession, it usually takes like 12 to 18 months for people to even agree that we're in a recession and that something needs to be done. This one was so obvious to everybody that the response was very, very quick. That being said, I think it's going to take several years, 2 to 3 years at least, to recover in some of these areas, particularly some of the harder hit travel areas. And even there, I think it's going to require a vaccine or some sort of burnout of the actual COVID-19 event for people to feel comfortable to get on airplanes in a big way. And in a way, the longer this goes on, which already surprised me, if it was just a month or two, I don't think people's long-term behavior, either businesses or consumers, would change much. But the longer this goes on, the more I think people are getting used to operating remotely. And it's gonna affect travel, I think, longer term. So, even in a recovery scenario, we may not get back to 2019 levels for a decade. It's entirely possible, given that people change their behavior.
Certainly on the business side of travel, that's for sure. So the question is, how well has the market priced this in? I mean, we're at all-time highs. Meanwhile, we're in the middle of a medical pandemic.
Yeah, I mean, it's interesting, with the extraordinary support that's backstopping really the activity out here. Obviously the fiscal policies are designed to help the unemployment situation short term. The Fed is obviously providing support and liquidity to the bond market in particular, which in turn is helping the stock market. I don't think that either one of those things are unusual when you're in a recession. That's usually what happens. The amount of firepower that's been brought to bear here is very, very significant, though, for sure. Now, if you look underneath the surface, though, at the stock market, a lot of people, when they come on financial channels, I hear them talk about how the market's anticipating a strong V recovery economically, et cetera. The market it's a market of stocks. It's not a stock market. And if you look at the individual stocks, what you see is the areas that are going to take time to recover: hotels, casinos, restaurants, bricks and mortar retailers, cruise lines, airlines. All these stocks are somewhere between 40 to 80% off their highs that were set in less than in 2019. So the market has really hit these stocks very hard. It's about a quarter of the S&P 500. And on the other hand, you have companies like Microsoft and Apple and others that are actually benefiting from this because businesses have to operate remotely, have to work from home, and are digitally transforming their businesses at a pace that's much faster than what it was before this broke out.
Yeah, that's an excellent point that you make about the market of stocks. It certainly makes it easier to understand. So let's go back to fiscal and monetary policies. They've been very supportive. What's your outlook on continued stimulus and interest rates? I mean, how much longer can this kind of policy prop the markets up? At some point, we have to pay the piper with this trillions of dollars supporting asset classes.
No, you're right, Joe. I mean, I think at some point, obviously, taxes are going to go up to pay for this. But, you don't want to do that when demand's weak or you're in the middle of a recession, which we still really are. So down the road, of course, taxes will go higher. I think taxes were going higher anyway, quite frankly, but now they'll probably go even a little bit higher than they otherwise would have. That's not positive net down the road for sure. But I think, if you look at the support that's out there, it's just, I don't think there's any choice for it right now. You simply have to provide it.
And to wrap up here, you also pointed out the cash levels are higher than March of 2009, and that tends to be a contrarian indicator. Explain to the audience what that means.
Well, what it means is, markets don't accommodate buyers. So if everybody's sitting on the sidelines thinking they're going to get a buying opportunity and they've got lots of cash in their accounts, what usually ends up happening 99 times out of 100 is they end up buying higher. Because if you've already sold and you're already out of the market, then the people that are left in the market are committed, and the ones sitting on the sidelines are just waiting for an opportunity to buy lower. They rarely get it when there's a lot of cash, because there's a lot of people trying to put a lot of money to work. It's over $1 trillion on the sidelines right now. There's an extraordinary amount of cash. So a lot of investors raise cash in the February, March, April timeframe, and thinking they would get an opportunity to buy the market lower. Hasn't happened. You know, the recovery's been stunning, nothing short of stunning for sure. Yeah. On a short-term basis. You know, I don't think anybody, myself included, ever predicted this on a short-term basis. Long-term, it wouldn't have surprised me, but in a quarter or two, it has been stunning. And so there's a lot of cash sitting out there that's fuel to buy the market higher, and that's essentially what ends up happening most of the time. So it's a contrary indicator. It's the exact opposite of what you think. It's like, okay, everybody's got a lot of cash, so they're scared and the market's going to go lower. No, it happens the exact opposite.
Yeah, it's really interesting, Doug. You know, as you had mentioned anecdotally, financial media, I've heard a couple money managers that have said they had their best quarter without doing anything, just because they simply didn't either sell or you know, they had the existing positions that were in there from the first quarter for longer term investors, and they had their best quarter for Q2.
Yeah, frequently, you know, we encourage investors, you know, to write it out, stick to your long-term plan. Don't try to market time. I know of nobody in this business in 34 years that I've been doing it that's ever been a successful market timer more than one time, one way, one in, and even that was debatable. So, you know, it's very, very difficult, if not impossible, to time the market. And if you ever had any doubts about that, I think the last couple of quarters should have put that to rest in most people's minds.
I agree with you 100%, Doug. Thanks so much for joining us on Trade Talks.
Thank you, Joe.
And thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.